What's up, everyone? We are back after a small hiatus. We've been off for a month. We're coming back, new year. We're probably going to try and keep this bi-weekly. The weekly is a bit of an ambitious goal with building a startup. On the other hand, we're trying to do something cool for all of you guys. So I'm here with Matt Niemerg, and Matt is a good friend. Matt's the co-founder of Aleph Zero. He's also a good friend of AngelBlock, and he's serving as one of our advisors. Matt earned a PhD in mathematics in the field of numerical algebraic geometry, which is more than I can say about myself, from Colorado State University. And Matt has been involved in crypto since 2014, and he's probably one of the few OGs left that I truly, truly respect in this space, since everybody seems to burn out. So Matt, it's absolutely awesome to see you and talk with you again.
Yeah. Thanks for having me, Alex. So wait, you say bi-weekly, not bi-monthly?
I say bi-weekly.
Okay. Semi-monthly.
Yeah. So how you been, Matt? You doing all right? You look good.
I'm good. I'm just taking my time, and no, not taking too much time, but I'm just doing what I can and moving on, and that's just kind of keeping a track of all the landscape that's happening out there right now, and it's a doozy, that's for sure. So
it's been a fun one, huh?
Yep.
Yeah. Yeah, this is these past few weeks in general, like I'm still trying to kind of develop my framework without going crazy. We talked actually about this with Anthony from Aleph right before going, seeing families for Christmas. We had Nick Merton, so Data Dash, Anthony, and Teddy Kleps on the podcast. We did like a roundtable wrapping up last year, and what are some of the things that we should look for or be maybe bullish about after 2022 going into 2023. And we took some time to kind of break down everything that happened. And one of the things that we mentioned was, I mentioned personally, is I'm really tired of being in crypto for as many years as I've been in crypto, and this kind of BS still happening, I don't know if that's what you alluded to, but
yes, there's that. That definitely that is troublesome. I mean, it's really just at some point you're just like, well, why are we even doing this? Like, why is this even happening? Like these were supposedly the adults in the room, and here they are running the same old tired tricks of Ponzi's and scams and frauds, and like it's not like it's 2012 again, where you're looking for the high yield investment Ponzi schemes, and like that was what was going on. Just scour everything on Bitcoin Talk or what have you. I mean, between that and Genesis is now filing for bankruptcy. They're doing Chapter 11, or at least that's what the rumors are. It looks like. And I don't know what's going on with this Bits Lotto, like the DOJ, going after that.
Never heard of it.
Like I've never heard of it. Never heard of that, right? And they're like, we're protecting retail, or protecting all these people. But one of the things that I did hear from some other people is that there's apparently a bunch of layer ones got asked by the DOJ, or by the senators. They sent out like a questionnaire to 20 different L1s supposedly about how what are they doing to do with respect to KYC on the blockchain. Like, and this was like a request, due to the at the same time as the Bit Lotto thing came out. And I don't know if it was related to that, or if it was just part of the their sort of inquiry of what they're doing. But it's interesting where the regulations are going to go on this, because they can't go after and ask the Bitcoin CEO to what's going on, right? How does Bitcoin handle KYC? Well, what's the difference between that and a actually true decentralized layer one? Is it really just, does all the actual regulations for OFAC and sanctions lists and all that, does that fall back to the customer, to the client, to the person who's actually doing the transaction, or is it at the network level? And if it's at the network level, then we really have a big problem whenever it comes to what the regulators are going to push. I mean, ideally, this is entirely as a communications platform. right? I mean, especially under the First Amendment, it's protected speech. It's nothing more than I have a message. It happens to be digitally signed, and I'm communicating that message to a bunch of other people on this sort of distributed network. And that in and of itself is protected speech, right? Like there's no question about that. Now, whether or not you say that the speech can create certain actions that are performed that may be regulated, transfer of assets to a somebody on the sanctions list, for instance. But the question with this is it's unclear to me is who's actually doing that action, right? If it's a collective action based off of consensus. No one single person is in charge of that decision. Yes, somebody sent a message that said, I want to transfer, some coins from my account with Alice to Bob's account over here, but that's just a message. You're just communicating a message and that's it. So why is that problematic? Why is that why would that in and of itself be an issue? And after that, who's responsible for whatever you have to do as far as the following the sanctions list? Because if I'm just I could write that message down and I could communicate it via email, and somebody else could go ahead and transmit it to any blockchain network, right? And what's the big deal? Like, I mean, I really don't know.
Yeah, it seems very strange because the regulatory narrative, is ever changing. But if you remember, and obviously I'm vastly simplifying all of this, but back in like 2016, 2017, 2018, so a few years back, one of the bigger kind of issues was how are you launching, right? Like it's usually the way that you launch, and that's why a lot of these ICOs were very problematic, is how are you launching this? Who has access at launch to these, decentralized or semi-decentralized networks? And are you taking money from retail? And those were kind of the hot topics pursued by regulators back in the day. And now what seems problematic, because from what I understand, those letters of inquiry, they're not just for foundations that are domiciled in the US. The kind of narrative that they're spinning is if you have a single user in the US, we're going to make it our business, right?
Yeah, and I mean that's the general notion, right? As soon as you have any nexus within the U.S., then you're captured, right, so to speak. Yeah, wow. I know. You're taking you're breathing in. You're like, oh man, that's just it's not really fun.
It's that GTA meme of like, oh man, here we go again,
Yeah, but here's the thing: is that the ICO situation and all this sort of like launching and that's a separate type of action. I mean, these are. I mean, for the most part, you look at what happened with the library case, you look at what's going on with the Ripple case, you look at Dragon Chain, you look at all these other enforcement actions that the SEC is doing, and it's seemed very clear, at least from a high level overview, that their position is that anything that is pre-mined and is sold by the main developing party, that is going to be treated as a securities sale, right? And that doesn't mean that, like, with Howie, for instance, Howie said that the investment contracts were the securities and those were what needs to be registered. It never said that the oranges themselves were securities. So that's the question that we still have ambiguity on, right? I got to say that correctly. We have ambiguity on is that we don't know if the actual underlying assets themselves are the securities or if it's just the bundle of the contract, and how does that work, with different parties? Is it because it's coming from the main developer? Is it from the quote unquote issuer? Who is issuing it whenever you have like a network and people just run nodes and they all agree that this is the initial genesis state? Like none of this makes any sense. I could create a network all day long and create a bunch of genesis hashes and say, hey, here's the starting balance for a bunch of accounts. Do you want in or not? And if other people are voluntarily, jumping on board, well, who issued this? Was it all the people who started at the beginning? Is it, is it the first person who created the block? Is it, what's the criteria? And this is very, very disconcerting not to have these answers. I
Yeah,
mean, especially
definitely.
after
And
6 years. Like, I mean, so
yeah,
now but I agree that the regulation and what people are moving towards or the regulators are moving towards are different, right? So this is a question on how are you guys doing KYC for transfers like innately, like, and this is problematic because it is speech. Like these entire all these networks are fundamentally speech, and that's it, point blank. There's really no other argument that you have against it. And so then the question is, well, what happens if, like I say, I gave an example. I could sign a message that initiates a transfer. That's fine. I can email it to a bunch of people. I can communicate through other platforms. So why is communicating that same message across a blockchain platform and then appending it to a log of all other messages? Why is that problematic? It's not the only thing that's happening here is state machine replication. You have a local version of the database, and your local computer is taking all those ordered messages and applying them to give you your current state of the database. And that's it. No one single person is actually creating you to cause a state change. You're running your own software client that is interpreting these messages. I could just be running a software client that only receives messages but doesn't update the state. Okay, so what's going on here? Like this makes no sense.
yeah. Would you because I have this idea that I've been mulling over in the back of my head, and not sure if you're going to agree here, but I think at one of the underlying problems that we're dealing with here from a more meta slash philosophical level is what value actually is has drastically changed over the course of the last, 15, 20 years, especially in the last decade. And one of the reasons that we're having these issues is because we're applying pretty archaic frameworks around what the transfer of value was and what it's starting to look like right now. Right. And like you just mentioned, a few minutes ago, you mentioned the Howie Test, which was, if memory serves me right, what was it, 33 or 36? So 20th century, beginning of the 20th century.
The Howie test was actually, I think, in the
Well, the
50s or
the
60s.
case.
The case
Oh,
was
really?
either in
Was
the
it?
50s or 60s. Yeah, I think I want, or no, 45 maybe. Now I need to I need somebody in my ear to
Yeah.
tell me.
Yeah, we're doing some quick Googling out of curiosity.
What year? What year? I
We're very prepared. 1946. The
Okay, it was
Howie
in the
Test
40s.
dates back to 46.
And then
Yeah,
and then the actual law was there were several different laws. You had the Commodity Exchange Act, you had the Securities Exchange Act, you had the Securities Act, and they were
exactly.
in like 1932 to 1934 or
Yeah.
5 or 7. I don't remember.
Yeah, so that's we're using something that's over 50 years old, like way over 50 years old, right? To kind of set the tone for where we're going, right? And should we be doing this is basically my question. Like, I know it's obviously easier to amend a working system than burn something down. Like, I'm not trying to advocate for burning down an entire regulatory or financial system and building it anew, but should we be taking a look back at everything and say, like, maybe we're just putting these stopgap measures into something that's going to drastically change over the next 2 to 4 decades, regardless of what we're doing right now?
I mean, I would think we need to take a step back and try to identify what is the real reasons for the regulations. If the idea is to say, okay, we want to protect retail because one, they're being taken advantage of. They're not smart enough to recognize a scam. They're not smart enough to know how to invest their money. Whether or not that and that mentality is interesting in and of itself. It's sort of the nanny statism, which I think is all fairly problematic. But what's the real reason? You got to be able to stop unscrupulous actors. You need to be able to say that these are project promoters. They are creating some type of investment opportunity for people, and then there's no protection for the mom and pop. And if that's the real reason for this, then it doesn't mean that the concept of that level of regulation isn't bad. It means that we've trying to use it in such a way where there's been updates to the technology, right? So since we've updated technology, we have new forms of communication, we have new sort of business models. Yes, there are some things that are overlap, but there's not clarity whenever it comes to, the example that Gensler has used before is that if you have if you're paying to, or you're investing rather for like a Broadway show, right? And the Broadway show has not been, you don't have any of the actors, you don't have any of the costume designers, you don't have the play written, none of that is done. But you're basically funding, or basically helping out Rodgers and Hammerstein. They don't have any capital, so now you're basically paying them to create the entire production, and that's an investment. Okay, well that's fine. That's I can understand that. And if there's nothing there, that's that's okay. But what happens whenever, what's the criteria for having a ticket to the show? At what point do you cross that line to say that this is no longer an investment? This is now, trying to get access to a functional network, and you're not actually paying, you're not actually doing an investment of money. I mean, at the end of the day, you have, what are we really doing? There's the exchange of value occurs for goods and services. So all companies either sell services or they produce goods that they sell. That's it, point blank. And if I have a good, it's a digital good, like, does that mean that and I can just happen to create it sort of via fiat? I mean, that's essentially what I'm able to do in the crypto space. How is that, if that is a digital good, is that, and it's workable and it has utility and it's immediately, sort of available, the network is done. Yes, I'm going to go ahead and maybe I'll improve my network. I mean, just like any other company does, they improve their product, they improve what they're developing and offering to their clients, and so so if you look at, say, the library case, which was basically saying that they sold coins that they had pre-mined, and then they use those coins to go ahead and develop the network better and to make software improvements and so on. Well, the SEC's argument is such that any company who is selling goods is then entering into an investment contract with all of their customers. And then anytime that they make improvements to their business in any fashion, if it's usable by their customers, then it becomes a security. Because now the value is like, it's like saying I have Chuck E. Cheese tokens, and now I'm using those Chuck E. Cheese tokens and the money that I generated from selling those to improve, like, the games, and to do maintenance, and to do to get better prizes. All of that is related to the customer and the client.
That's how all Kickstarter works, right? Like,
that's how all companies work.
But it's even more. You can see this at a real, like, face value when it comes to Kickstarter, because then it's even funnier. And I think the crossover to crypto is even better, because a lot of times you have companies selling products, right? Like, I was part of a Kickstarter for a backpack I wanted, and they were pretty blunt. Like, yes, we're raising like 700K right now, and if everything goes right, we're going to start shipping these out in 2 years, right? So it's perfect. It's, you're raising money, then the product is quite a ways away before the end user or the consumer is actually going to get it, right?
Yeah, I think the issue from a regulatory perspective, or the difference rather, is that with Kickstarter, you had the Jobs Act of 2006, I believe, or what have you, and this essentially changed the way that you could do crowdfunding, and so then a lot of these are portals that allow for that. So they're basically packaging it all together and allowing for companies to do this raise, and then they're charging them, whatever, a small percentage of the total amount raised, but they're doing it in a way so that they are fully regulatory compliant. And I don't think the SEC doesn't have an issue with this so much, no, but
they do
because they're compliant, right? So but the question is, the problem that I have is that people go in and they talk to the SEC. And you even saw this with I guess with Genesis or Gemini as well. They went in to talk about their earn program, and 17 months later they get slapped with an enforcement action. So if companies go into you and talk to you,
To start a dialogue, open lines of communications.
To have an open dialogue, then you shouldn't necessarily be, worried that they're going to come after you because you've given them all the details for you to, for you to get sued by them, or to get a civil action done. It's just, I mean, like, I don't know, like it's one of those things where I don't like keep hammering this topic, but it's so crazy. Like, how is this like even going on anymore? Like it's so old. It's such an old topic. It's like, I just can't believe that we're talking about it today.
Yeah. That's one issue that I have, is because I feel like this has been a pretty hot topic definitely since I entered the space a few years back, and it just doesn't feel like we're making any headway. Right. And that's what's infuriating, is like we're in a car that's stuck in mud, and all we're doing is we're mashing the gas, and like, well, we're still stuck. We're not. And, 6 years later, we're still doing the same thing. We're not going anywhere. And it's tiring, and that's when we mix that with everything that we talked about in the beginning, which is, the Celsiuses, the Voyagers, especially the FTXs that happened towards the end of last year. Like, it's really tiring. like all of this BS put together.
Well, I mean, you have that. You have there's no spot ETF like yet, and I mean, like, this is, and so what does that do? That only gives you. I mean, you look at what Genesis, and rather what I guess Digital Currency Group is doing with GBDC, and they get their sweet management fees, sweet. Like, it's just, it's such a racket. It's like, why doesn't the SEC want to allow for a spot ETF? I think they have a short ETF, but there's no spot ETF.
Yeah. They do. Yeah.
So what is going on? Like, this is pretty capricious. This is fairly insane. And then you have these. What's Caitlin Long's bank out in Wyoming? I know that she changed the name, or they changed the name a couple of times. But like, she has to sue the feds to be able to get a bank to get like access to the Fed system, to get a Fed account, because they won't give it to her, even though she's complied with all the rules and is perfectly suitable to get one. So now we have to deal with all this other BS because they don't want to. They create the rules, you follow the rules, you're playing ball. And then they don't want to follow their own rules, and so you have to take them to court. It's just, it's insane.
Do you think this puts the U.S. going forward in a geopolitical disadvantage?
100% yes. Like, this is we've dropped the ball completely, or I mean the U.S. has dropped the ball completely on this. They are. I don't think you need to be Europe, where you need to be like trying to touting to say that you're creating, you're leading by regulation. Like, nobody wants to lead by regulation. That's like such a horrible brand. I don't know. I think it's a horrible branding, thing. But I mean,
that's a bad unique selling point.
I guess if you're in Brussels and that's what you want to go for, like, have at it. But it to me, it doesn't make any sense. You want to lead by innovation and by common sense business, and basically creating the environment to allow for businesses to foster. I mean, honestly, probably the best is still Switzerland. I mean, it's just clear cut. They were progressive enough on creating a framework. Obviously, there are still things that are in flux, but the rules aren't going to change for like a good 20 years, and it actually allows people to operate and not necessarily be stuck in this sort of limbo.
Yeah, definitely being outside the EU jurisdiction helps there too, right? Like, Switzerland just being able to do their own thing for as long as I can remember, right? And it's definitely going to start paying dividends, it looks like.
Yeah, I think so. But yeah, I mean,
wait. I'm scared to say pay dividends, because I might be considered, that I'm preaching for securities or something.
Yeah. I know, right? So what's actually one of the things that's interesting. Well, all right, so maybe a different that's not so important. But back on this whole Bits Lotto, I don't get what went on there. Why are they trying to create some type of a protection for something that I don't think anybody needed protection from, at least in the States?
Is the protector meme? I'm protecting.
Yeah, there's all these other crap that they could have helped with. And it's like low hanging fruit. It really is low hanging fruit. Like what was going on? What's in their minds? Um, but yeah, for senators to come out and ask all these L1s, what are you guys doing about KYC? Well, like it's always been the case that it's been, like if I'm a US citizen, I can't transact with anybody from Iran, like or North Korea. It's always has been on me to not do those types of actions. So why would it be on any layer one? It is
Yeah.
I don't get it. I don't get it at
Do you
all.
think that do you think the end game? Well, to be honest, like
The end
looking
game is to
at
regulate out of existence.
yeah, and but do you think part of the end game, because a lot, we obviously had that entire discussion a few years back. Like, I mean, we as a community, it's the collective royal we, that Bitcoin is most likely a commodity. Now, there's obviously it was said that Ethereum is possibly a commodity, but it potentially started off as a security. So apparently it's able to kind of make that switch. Do you think that there's this end game that maybe someone on the inside is going for, just to maybe keep Bitcoin the non-problematic child and then just regulate everything else into oblivion?
I don't know if that's I don't know if that, I mean, there's some maxis who are in Congress, um, and that may be their goal, but I don't know if that's necessarily like the compromise that the SEC is trying to go for in the end. I do think that whenever you're crowdfunding and you're sort of deploying a new network and it's not, you still have to do all the major code development and everything. I mean, it's probably a security whenever you have to raise funds. So yes, I most likely the actual initial Ethereum ICO, because there was no code, there was no network, there was nothing, right? That was a securities offering, and that was why aren't they going after the Ethereum Foundation and like actually finding them? What's going on? Why this is insane. Just like slap them with the fine, move on and keep going. But they're not even going to do that, and that's like an even lower hanging fruit.
So one thing that a lot of projects
So
have
so
started
so, so
implementing
all
going
right.
forward is
Sorry,
no, go ahead, go ahead.
I wanted to say then the solution is just avoid the U.S. Like don't sell to the U.S.
That's where I was going.
That's basically the only answer is. And what does that do? Well, it just leaves U.S. behind. It leaves the U.S. citizenry behind. If you don't get access to this new financial system because your representatives are slow at creating reasonable regulations, reasonable laws, and you have the same situation, and then you have like the DOJ and the SEC that go after crazy stuff, and it is what it is. So yes, the U.S. is going to be far behind as far as the regulations are concerned. Innovation has been fleeing this country for ages. Because of that, and then also you're just going to leave, basically your entire citizenry and your population, out in the cold to this basically this new digital economy. Now, as far as there are ways of actually getting around this. For the most part, you can actually get securities into the hands of the public. So, say for instance, these are actually all coins that were ever sold in an ICO or in a private raise or whatever are securities, and you don't ever sell to anybody in the U.S. Okay, so you have a single issuer. That's fine. It's these foundations or the developers or the company that's behind it, and you have your affiliates, you have your insiders, anybody who's on the board, anybody who's a part of the team. That's fine. These are affiliates under the these regulations. And so now what do you have? You have certain restrictions on what these issuers can do. And they basically just don't ever sell to anybody in the States, ever. And then they never have to file
Regardless of accreditation.
Yeah, if you don't do that, you're fine. Then you have then you just let everybody else who's foreign wait a year before they sell to anybody in the States. And as long as they're not like an insider or like an advisor or things like this, they're technically not an affiliate, and so then they can sell to general retail without any registration, without anything. Now, as soon as the there's a buyback by the foundation or the initial issuer, like in the instance of like say a share buyback, then those coins would have to go through the exact same process again. They'd be sold to somebody who's foreign, wait a year before they could be sold to somebody else who's non-foreign, or to somebody who's domiciled in the States, and you should be good. Like, I mean, obviously I'm not a lawyer, but that's my understanding of how this could work. So if you were to sort of like add in a whole bunch of secondary KYC components where you siloed off U.S. persons versus non-U.S. persons, and you wanted to track everything, you could actually show that you're being fully compliant, that none of these coins ever flowed through to a U.S. person for that year period. And then now you have like you have two separate markets, one market for U.S. persons, one market for non-U.S. persons. And I mean, it's all doable. That's what the blockchain can be used for from an accounting perspective, but it's so cumbersome. It's like, that's just so nothing that we want to be able to do at all. We don't want to do that. Like, that's just
the mentality that I see with a lot of projects raising now is simply we're not including the US. We're not even looking in the direction of the US. The US does not exist to us for the time being, right?
Yeah.
And that's a whole other problem, right? Like, so as you just mentioned, it's doable. Like, everything is doable, and it's doable in a legally safe, well, quote unquote, there's risk and cost and everything involved, but a lot of these projects are simply excluding the US because that regulatory landscape is ever changing. You never know when the hammer's going to come down, and it's just easier to exclude them than to even start enticing this idea of maybe having someone on board.
Well, you know the solutions behind most of this. You have somebody who's foreign, entirely foreign, no U.S. nexus, and then they create a company overseas. And then they can take in U.S. investors, and then that company itself can, as long as they're all accredited, they can go ahead and invest into the ICOs, and so then that's no longer has that U.S. nexus, right? Like,
yeah, I mean, and it's been happening for years, right? Like, that's what makes everything even funnier. Like, it's been happening.
But then you also have all this stuff where you get sort of these equity plus the token warrant options, right?
Yeah.
And what's unclear to me is, I believe that, so under the law, what you have to register with is the securities offering. You're not actually registering securities itself. You're registering the sale of securities. So
you're referencing Reg D right now?
Yeah, I'm just referencing like broadly what the rules are about. And now the question is, if in your offer you're doing a combined safe plus token warrant, right? That is a single offering. And now whatever tokens that you might receive from the warrant, if they ever do come in existence, that's part of that registered, that's part of that registration that was performed. So it's like you're registering for the safe, for the equity, right? And then, you don't have to register if there's a conversion because you only did one sale. You did a sale for the safe, but it's a safe plus this token warrant, and that in itself is a bundled investment contract. And so then the same major question is, the underlying asset itself, is that the security? And so are secondary sales themselves going to be required to be registered? And this, hopefully we get some idea from say Ripple and the summary judgment on that front. I just like how I think it was Judge Netburn basically said that the SEC does not have a faithful allegiance to the law, whenever it came to like it, and what's in these Hinman emails, like what why
serving
are they
as judge, jury, and executioner was another quote that came out of last year.
And then what, I really want to see these Hinman emails. Like I don't want to say I'm following this as crypto drama. Like, I actually just follow a lot of legal stuff anyway, but
it is kind of crypto drama.
It is crypto drama, but like you can tell, I'm not a lawyer, but I'm fascinated by legal issues and by the law and what the rules really are. And it's not like these are, I don't think they're necessarily difficult concepts, but they are fascinating, and they're interesting sort of questions. They're human questions.
Yes,
it's completely different than math, obviously, but it still has that same logical framework. And it's just one of those things where, why can't we get freaking clarity?
And that's all we've been asking for, right? Which is kind of the ironic and hilarious part, because since I can remember, we didn't say we want pro crypto regulate. Like we didn't ask for, hey, we want tax breaks. We want to be able to do everything that we want. The thing that we've been asking for years is clarity, just clarity. And it seems so simple, but they haven't even been able to deliver on this, in the tiniest percentage, right? And that's what gets so infuriating, is because we're saying, hey, like, it's not that we want us to, it's not like we're asking you to allow us and make it legal to offer, 30 million APY degen crypto Ponzi's to everyone and their grandmother. We just want some clarity. And they're like, no.
I think we should be able to offer that to everyone and their grandmas, and everyone and their grandmas should be smart enough not to participate. Like,
true. I am of that same mindset. Just for the record.
Back to what's the so there's other. All right, so this entire conversation has been around the central theme of regulations, but now you have, even beyond that, we still have all the DeFi stuff, right? So this is what's fascinating to me, is that you have in the Commodities Exchange Act in the U.S., you have basically the primary thing that you're trying to regulate are the centralized parties. So whether or not that is the clearinghouses or brokers or somebody who has custody of funds, somebody who might have access to information that's not available to the general retail public. So somebody who's in a particular position of power that could manipulate the markets, that could manipulate their clients' funds. And these are the parties that they're trying to regulate. On top of that, they want to regulate anybody who's offering leverage, right? Because, if you're using leverage to borrow money and to go ahead and speculate in these markets, because it's just, degenerate gambling. At the end of the day, Wall Street is just nothing more than a big giant casino. And we need to regulate leverage and the reason behind this is because people don't know math. They don't get why, what's going on here. Fundamentally, you have for every increase of leverage that you have. So if you go from, say, 2x leverage, you actually have a quadratic increase, so a 4x increase of risk. So this is just basic statistics. There's nothing fancy about what's going on here. So that means that if you have a 10x leverage, you have 100 times more risk. And by risk, I mean how much variance that you're able to tolerate, how much volatility are you able
before liquidation.
Before you get liquidation. So you have a linear increase of rewards, but you have a quadratic increase of risk. And this is one of the reasons why it's easy to be liquidated, right? Small price movements on leverage allows you to be liquidated much faster. And so now we need this is the other thing that they want to regulate. So back to the sort of the initial topic that I brought up whenever it came to the securities laws. What's the actual real reason behind the regulation? The real reason behind the commodities regulation is we need to regulate leverage. We need to regulate centralized parties. Okay, well, with DeFi, there's no centralized parties. What you really have is you have smart contracts that are aggregating services that are available in the private markets. Right, so you have peer-to-peer sort of loans and sort of over-collateralized loans that are occurring, and that can happen in the private market. I can go out and I can buy gold from a dealer. I can take that gold and I could maybe deposit it with some other private lender and say, hey, look, I'm using this gold here as collateral for cash money. I go out and I buy more gold again. I go to maybe a different private lender, maybe not the same one. And I say, look, I'm going to collateralize my gold. I want cash money. And I rinse, repeat. And what does that do? That gives me leverage on a gold position. But they're not regulating that. That's not and that's fully opaque. Those are a series
and it's
of
the same.
And it's the exact same thing. So now you have these opaque and private markets that are completely non-regulated, that give you the exact same functionality of leverage that is occurring in an automated fashion and completely, I guess in this case, in basically in a singular interface, right? So if you have like say a brokerage firm, or if you're some company that's offering leverage, well, it's because you don't have to do that series of steps or you just get access to just this is automatic, right? So I mean, in a lot of sense, options trading is just a different type of leverage. So this is why all these things are really trying to be they want to regulate them. So now the question then becomes, okay, well, if we have DeFi, there's no centralized party. It's just the peer-to-peer marketplace that's been aggregated. What is this a regulated activity? Like, if I'm able to do this for this gold situation that I just explained, why can't I do it in crypto, and why can't I do it in a automated fashion where I don't have to actually go out and I mean, yes, somebody has created an interface that aggregates a broader marketplace, and a broader marketplace of willing lenders and borrowers, just like they do whenever they are offering a brokerage firm, and they're doing this in a for basically leverage on a margin account for say basic security. So if I'm buying Walmart on margin, I can short it, I can do whatever, I can long it, I can borrow, I can get up to like say 5x margin or 10x, whatever the sort of the cap is in the States, and that's fine. But the entity itself that is offering that is basically aggregating those same private services, but they're taking on additional risks themselves. They're taking on the as a central counterparty, they're taking on risk and basically taking on both sides of everybody's positions that are doing. But now if you have in DeFi, you have these smart contracts that are fully transparent. They don't have a centralized party who is taking on that risk, and you know exactly what the positions are of everybody. So there's no information asymmetry. You don't have any you don't have anybody who can manipulate the markets in the same way that you do with these centralized clearinghouses, and you have nobody who's custodying your funds. So what is being regulated? Why?
Where's the issue?
Where's the issue at? And then separately, you have all this other stuff whenever it comes to quant finance, right? And portfolio replication theory. So there's a bunch of math out there that has been recently discovered, and the language has been developed and created. But I mean, math is discovered as a fundamental concept, or this is my opinion, but then the language itself has to be developed and created. So people always just sort of the one of these sort of philosophical questions in the math world is math invented or is it discovered? Math is discovered, but the language to describe the math is always invented, right? So like you got to think of it from that perspective, because you have to create the interface. You have to create the interface. So it exists. It's out there in the ether, so to speak, right? And that doesn't mean it never existed without the language. It just means that we didn't know how to describe it. So we have to invent the way to describe it, the formal math language. So now you have all this new stuff that's come out, 20, 30 years after even your the Securities Act and the Commodities Exchange Act. This is like, say, stuff that came out in the 60s, where you have all this stuff with portfolio replication theory that says that you can create with nothing more than being able to borrow assets and to sell them at spot. You can actually create a portfolio with the same payoff functions as options trading. So these are equivalent. They're all the same thing. The math says that they're exactly the same. That means that if I can do a series of transactions that give me the same payoff, I can use the same leverage. It's giving me the exact same leverage as if I were just to buy directly options.
So would you say that a mathematical and technological illiteracy is basically what's holding us back? Or is it something more nefarious?
There's that, but that's always been the case. That's never, that's true. Not really
but maybe not to the same extent of influencing our regulations and an entire industry to this extent, perhaps.
Right.
Not sure.
Right. So now you have all this portfolio replication theory stuff, and now you have all this new things that are coming out with these. You look at what, say, Primitive XYZ is doing, or there's some other replication theory stuff that's pretty cool. And instead, they're modeling these payoff functions using strictly an automated market maker. So now I can go, and then the idea it being that it acts as a price oracle, so that whenever there's potentially arbitrage relative to the rest of the spot markets, people come in and can, adjust it accordingly. So eventually the payoff function is going to mimic as if you were to say to take a short position on an or with an option or do a put option. Either you're writing a put option, buying a put option, writing a call option, buying a call option. You can create these automated market maker function, automated market makers with, instead of doing the classical Uniswap sort of constant function one, you just do a different function that defines what the payoff strategy is, and it gives you the equivalent solution as if you were basically buying an option or writing an option. And is that like, is somebody actually offering an options contract? It's not an options contract. It's technically just buying a liquidity pool share. I mean, maybe not a share, but you're buying a different asset, and this different asset then is using Oracle price feeds and putting itself out there to the rest of the open market and say, hey, I am willing to buy and sell other assets at these prices. If anybody wants to buy them or sell them to me, this is my quote. And those prices adjust accordingly over time. There's theta decay and so on and so forth that mimics an options pricing model. Now, all I did was just buy that asset that just represents this, the price of that asset just represents the change over time of an options price. Did I buy an option, or did I buy a different asset? And so then now, if we're talking about math illiteracy, and I have no idea if this is probably true, but my intuition would be to say that these are probably some weird category that's equivalent. And that's some strange upper level math that is beyond even anything that I mean, basically it's just saying a way of just saying that there are things in the math world, objects, that are innocuously, they look different, but they're actually the same thing. So, I mean, in this way, it's basically saying the same thing, right? We have these assets that are fundamentally different. You have different actions that you're able to perform on them. You have different functions that you're able to modify them and to do with them. And they give you the exact same end result. So that, to me, that sounds like there's an equivalency between them.
One would think so. Then why are they regulated differently?
Well, exactly. So if one is regulated and the other is not, then what are we doing? Like, it just doesn't make any sense at all.
So do you think that a wait and see approach in general in terms of regulating crypto is better, or does that open a whole other set of problems that maybe we just haven't dealt with yet?
Wait and see. I mean, look, to an extent, Gensler is right whenever he says that a lot of this is the same old schemes. There's, nothing's new under the sun. And I'm not faulting them with like partly that position. What I have an issue with is just what's the dividing line. Like, these are fundamentally, like, we have new information, we have new technology, we have like a new business models, and this is not exactly the same scheme, right, as before. I mean, if you look at everything that comes with these securities laws, it's all based off of facts and circumstances unique to every single case. So whether or not something is an investment contract is fundamentally unique to the facts associated to that particular case. And yes, that becomes problematic, but you need to still provide broad rules and guidelines so that beyond just saying, well, look to the securities laws and look to Howie, like, that is not guidance. That is not like useful in any sense of the word. But as far as wait and see, like, no, we shouldn't wait and see. We need to educate. We need to do we need to grow up and do what all the other larger industries do. We have to go in. We have to lobby. We have to basically get our own lawyers, write the laws that we want, basically donate to the politicians, convince them to use the law that we wrote for them. And they don't need to read anything, and they just propose it, just like they do with everything
Seems
else.
like we were doing that for a bit, but it turned out to be a bad actor for crypto that was doing a lot of that lobbying, right?
But yes, and also it was
talking about SBF. If anybody doesn't,
the
follow.
other issue with that is that it was basically his suggestions were all protection rackets, right? I mean, which is no different than other industries, but like at some point, there's just some basic clarity that we could do, even with, say, the tax law. Are these assets newly created? Is this new property? Is it, like, if I just say from fiat, I've created new property, and everybody else says, you know what? I agree with you. You've created new property. Okay, well, was that income? Like, because in any other industry, like if I'm a farmer and I grow corn, I'm not taxed until I sell that corn, right? Yeah. So like, if I just say, look,
and that's where the staking and taxation of staking comes into play, and all that good stuff.
Or even mining, like if I say, look, I'm a miner, I mine Bitcoin. I say, look, I have found a block, and in that block, I have the set of transactions. I can have the puzzle hash that I've been able to solve, and I just happen to say, you know what, I'm going to give myself, or this particular address that I control, 6.25 Bitcoin. Okay, well, everybody else says, you know what? Yes, we agree with you. And, and on top of that, if I agree with you, I'm also going to give myself 6.25 Bitcoin, right? Like, so who created it? Is this self-created? It sounds to me like self-created property.
Yeah.
And if it's self-created, then there's no taxation until sale.
Yeah, how on earth are we supposed to tax this, right? And that's where I actually think a lot of tax regulations regarding crypto in the EU are pretty good. Like we had our own problems here, right? Like there was a tax that was very briefly implemented in Poland, which was like we went from one extreme to the other, because back in I can't remember whether it was 2017 or 2018, the first taxation on crypto that was implemented, we were in theory taxed per transaction. Mm-hmm. So every transaction over whether it was the Bitcoin network or the Ethereum network, every transaction should have been taxable, which is just insane, right?
Well, that's how it is in the States. Like you have to track every single transaction and what is the barter, the value from one to the next. So, I mean,
but this is intra wallet transactions were
between your
yes,
own moving your own so if you're moving
every single transaction on any chain, even if you're just doing 10 transactions to yourself, all of these constituted a taxable event.
That doesn't make sense.
Absolutely. It was implemented for a very, very short time. It just demonstrated that these regulators, they had no clue what they were dealing with. But what they implemented after that makes a lot of sense, which is it's basically where it stands right now is if you're, on Uniswap and you're converting USDT to ETH or the other way around, that is not a taxable event. The taxable event occurs when you're converting it to a fiat currency.
Well, that's nice. I wish I could have
that is nice.
That. I wish I could
it's very nice.
I wish I could have that. Then I would not be so worried about a lot of stuff on paying for these taxes that I owe. It's just not fun. But I basically have stopped all trading because of this. It's just one of those things where it just becomes so cumbersome. It's just not worth it. So it's mainly.
It's not even about the money. It's about the time that you're spending and all the information that you're aggregating.
It is ridiculous. And even now, whenever it's just like. Just even short-term, medium trading positions, it's not even it's not fun to do. Yeah. Nonetheless, if I were to actually be doing constant day trading, which I mean obviously I just still don't even have the time for that because I wouldn't even be able to talk to you about these types of things. So it's so crazy. And this is not a problem that is, regulations and what's happening on that front is not an issue just with the U.S. You look at MiCA, for instance, or MiCA, or however you want to say it.
Yeah.
Like, and that's.
I heard both, so.
I don't know what is going on over there in the EU whenever it comes to some of the choices that they're making with the regulations. It's like one of those things where, yes, we need regulations and we want clarity, but really, like, this is your interpretation of this. This makes no sense.
Yeah, and it creates a lot of these regulations. They just create additional, let's call them gray markets right now. So one of the propositions in MiCA is that you need, I believe, 10 to 15 years of traditional financial experience in order to run an alternative asset VC fund. So a lot of these crypto VCs right now that are located in the EU, they're going to have some kind of new director or person that's pretty high up in the hierarchy, probably like the managing partner or the managing director, who has all the paper in order to say, like, yes, this is my experience. I am, experienced enough to deal with this. But I already know of VCs that used to be domiciled in Europe who are simply moving everything. Right. They're moving all of their business to offshore, right?
Right.
And
Hey, so I was just going to say
another day in crypto.
Yeah, well, I mean, that's just not even just crypto. That's just normal regulatory arbitrage.
Yeah.
So,
yeah, exactly.
It just doesn't make any sense to me that you want to just, create these incentives. That's because that's all it is. You're creating incentives for people to hop around and shop for like the best rules. So why not just offer the best rules so that people don't have to move?
Yeah. And last time the Bahamas did that, it didn't work out too well, right?
Yeah.
Yeah. So
anyway, it is what it is. So I'm holding my breath on the summary judgment from Ripple. I do think that it's going to be fairly positive, to be honest, and I think that's going to give a lot more clarity on what to be doing for moving forward with any companies that are looking at raising and maybe targeting the U.S. But it's not. It's not going to be like this pinnacle, end all, be all, great feather in our cap for the entire industry, because, as I said, it's still facts and circumstances. But there will be at least some more. I think people will feel less trepidation. And my guess is that any initial sales that were done by Ripple will probably be considered securities, but then secondary or required to be registered. But I don't think secondary sales are going to have to be registered. And I guess we'll that's my guess of what's going to happen. But even then, how do you know? Like they even registered like they did all their registration for their company. Like they did all these things anyways. Like, what is the problem? Like, I don't know. I don't think that the SEC was expecting such a fight.
Yeah, it seems just from how long everything has been taking, it definitely doesn't seem like they knew exactly what they were getting into when all of this started.
Well,
right?
Obviously they didn't. You look at all the things that they filed, and you read, they just keep on changing their argument from one thing to the next, and they're like holding two contradictory positions at the same time, and they're saying, let's just see which one sticks to the wall. Right. I mean, that's all it is.
Fun fact: a lot of licensing processes for crypto look just like that. I've been through a few in Europe, and they're contradictory, and the checklist keeps keeps expanding and expanding. So,
well, no, but it's not. I mean, that's a different story. But this is like saying I'm going to argue it, to the court, and I'm going to go to the judge, the final arbiter, right, and say two things. I want to take these two different positions. Whichever one works, I'm going to go with.
Yeah.
And you get
which one do you prefer?
Which one do you prefer? And you don't get to just make one decision and argue that. You get to just say, do I get to do that as a defendant? Can I take multiple positions that are potentially contradictory? If the government can do that, surely I can do that.
It's one model to emulate.
Right? If they're allowed to do it, then I should be, because they are me, right? Like, isn't that the whole point?
So Matt, where do we go from here? Where do you go from here as an industry? Because this was I don't want to say this was bleak. I don't want to say this was bleak, but this was definitely a reality check. This conversation.
Yeah, I think just build and avoid the US.
So build, raise, exclude the US.
Yeah,
Do the
but
DYDX,
offer
do it
but
DYDX style.
yeah, but offer like, I mean, you could run your, so some of these interfaces, you need to open source your interface so people can still run it on their own local
Yeah.
machine.
Yeah.
And you can geo block all you want, but make sure that it's easy just to yarn deploy whatever it is that I want on, and use this platform on not necessarily me for instance, but it's just, yeah, just like throw it up on a server outside of the US, use a dynamic proxy forwarding, and I don't know, VPNs, right? So you have VPNs, which gives all full traffic to be encrypted. But there's another way that you can actually use to redirect traffic on the internet, at least only for the browser, and it's only for a particular port, and that's called dynamic proxy forwarding, or dynamic port forwarding rather. So it's like the -D option whenever you're using SSH, if you ever do command line stuff. But what this allows you to do is, in your web browsers, you can say, I want to take all incoming traffic from port whatever 419, and from there go ahead and also from this particular IP address, and I want to treat it as if it was traffic on port 80, which is your standard HTTP port, and also I think they automatically treat it as if it is encrypted with HTTPS, it also treats it as if it was forwarded on port, as if it were 23. But what that does, it doesn't give you like all communication like you would on a VPN. That's basically saying that that's on a VPN, that's encrypted. But it does give you anything that for a web browsing purposes is going to be on those encrypted channels, and then all the websites see the other IP address that you have, like basically a vulture server or something in Europe or in South America or whatever. They see that as your IP address. So this is what's nice about it. It doesn't necessarily flag all the VPNs because these are standard IP addresses that all these companies know, and they'll block you on that front because this is just a random server. It's just any random server. It's like a web server, and it's a web server that's just basically communicating on your behalf to some other web server, and then forwarding all that information through the particular port that you specified back to your web browser, so you can see this, see your beautiful face. If I were to be running a dynamic port forwarding solution right now, like, I mean,
build, open source, decentralize, propagate,
yeah,
and then rinse, repeat.
Yeah, so there's all sorts of fun ways of doing this. But yeah, I think it's really more about build. At some point, we need to do more on the regulation side and lobby. But there's some great organizations out there. You got, at least in the States, you have Coin Center, Blockchain Association, and some of these like that. And just the thing is that the big boys are out there, and they want reasonable solutions as well. So you got, Paradigm and people with actual capital that can, and not just Paradigm. Who else is there? There's a whole bunch of other sort of, you got A16Z, you got Sequoia.
Yeah, A16Z.
It's like these guys are in the space. They want reasonable rules. They want to have clarity, and they are doing some things with like these amicus briefs with the Ripple case, and they're trying to like fund the coin centers of the world to help draft reasonable policy, and they do the education with the regulators. And I think that it's crypto is mainstream. I mean, like you got 30 to 40%, even in the U.S., of people own crypto. So it's like a apolitical position. It's probably going to be the largest voting block in the future. And ideally, regulators are going to, and Congress is going to figure that out, and they're going to start taking more positions that are sane so that they can get that electorate. But as far as what we do as an industry, just keep building, focus on development, focus on real world sustainable use cases. None of this. So whenever I say real world sustainable use cases, I mean, if you really think about, and this is not even like in crypto, but like this is the case with all new startups. everybody is operating on this whole sense of debt, right? They're always, it's always debt ridden, and nobody is actually generating revenue. It's like, I need to go ahead and raise all this capital, and I'm going to raise all this capital, and I'm going to use it to grow. But you have no idea if they don't even have a business model yet. They don't even have a proof that this is scalable, and they need a blitz in order to get out and be quote unquote first, when
because that's what everybody else is doing as well.
And that's why 90% plus of startups actually fail, is because they are actually doing that particular model that everybody else is doing. And the ones that succeed are actually focused on revenue generating, sort of business products. And if you actually, get down to the nuts and bolts of it, I know, right? If you actually focus on products and services that people want, and you get yourself in a position where, yeah, maybe you didn't raise like 10 or 15 million on a $200 million valuation, boo-hoo, but you have ARRs of like, say, 2 to 5 million a year, and you have like whatever your operating expenses are in the, basically you're in the black. Like, who cares? Like, just,
yeah.
I mean, now you have
that's what the end game should be, regardless, right?
Right. Like, so you're in the black. You're working, and now the crazy thing is that if you still want to go ahead and scale, you're in such a better position to go out and command. You're in this driver's seat. You can command your valuation if you're in the black. If you're actually generating revenue and you're saying, look, I just need more funds to scale, because we're going to repeat the process that we are, and we're going to,
because we know what we're doing,
because we know what we're doing, and we're going to grow it to the point where it's it caps out, and we just need more capital to keep doing what we're doing. And like, but the thing is that people just don't do this. They don't think this way. They think that, well, the government is overspending, and everybody else is just entirely in debt, and let's just use other people's money and just finance.
And it looks like
lifestyle.
a good time, so I should do the same.
So I should just do that, as opposed to just do the grind, do the hard work, and actually build out a real sustainable business. And anyways, that's probably what I try to look at for whenever I look for even investments and opportunity, is like, is this actually a founders that are going to grind, and is it going to be people who are is it going to be founders who grind? Is it going to be like a product that can be sustainable, or a service that can be sustainable, and kind of go from there.
I like that. Let's leave it on that note. Matt, I love it. It's backwards.
Sorry, I got distracted by my daughter. She was
this is a good reason to be distracted. I love that.
Yes.
This is amazing.
Yeah. So to recap, like what that means is that don't do what everybody else is doing, right? Like, if that model that everybody else is doing if that model is the failure model, like, why would you do it? Like, that makes no sense. Just look at what is actually successful and do that instead. And really, in the end, real success is, most of the time, it's just doing the work.
Well said.
Almost 99% of the time, it's actually doing the work. Yes, of course, you're going to have, you're in the right place at the right time, but that's not the majority of the cases. By and far, people just have to just buckle up, go to the grindstone, do the work, and maybe you're not going to make the millions or billions or whatever it is. But you'll survive, and you can actually create something that's long lasting and has the.
Yeah, but at the end of the day, what you want to impact people, right? Like, obviously, doing that at scale is great, but you want to be profitable. You want to impact people. You want to do something that makes it so that your work is felt, right? And just going into massive debt and raising massive sums of VC capital is not necessarily the way to do it.
Yeah, and also to kind of take that point of the impact that you have, in a way that being successful, that's the market telling you have impact, right? So if you think of value accrual as a as a way of identifying inefficiencies in the system, and your value accrual is basically making an impact of improving some type of inefficiency, well, that's it. That's essentially money, right? I mean, money is just a way of describing how good you were at providing a good or a service that was potentially inefficient to the rest of the people in the market.
Yeah, Matt, we have to wrap up. And this just showed me that we need to do this more often and for probably longer than we planned for. So I really want to thank you for your time, because every time I talk to you, like, my mind is just expanded even more, and I just have such a great time talking to you. So I really want to thank you for your time. As always, it's absolutely amazing catching up with you, and we should do this again soon.
Absolutely, Alex. Thanks for having me.